Hey everyone, happy Thursday, November 2nd. It's about 11:30 on the West Coast and time for another market update. Really crazy busy week, so I'll get right into it. First thing we got, the Fed finished their two-day meeting yesterday, and that's when they make their rate hike announcement, whether they'll cut, they'll pause, or they'll hike. We always want them to cut. The worry that there'll be another hike. They pause as expected. So what's next? They come out with their statement after they do their announcement. Statement basically was the same verbiage they had given in past statements. Basically, inflation is still a little too high, the economy's strong, the labor market's strong, things like that. And then Fed Chair Powell gives his press conference afterwards, and we pay really close into that, trying to get an indication of maybe where they're leaning. And I will say that it's basically a lot of the same verbiage again that they've been using as far as inflation being too high and things like that. But they did recognize that some of the hikes they've already made have created an economic environment. They've tightened credit, they've tightened financial conditions. There's less lending. That will have an effect on hiring. That will have an effect on inflation and things like that. So, our take on that would be basically what they've done is already done their. They don't have to hike again. What they've already done, it will basically create a new hike by tightening things even further. So hopefully, they look at it the same way. Their next meeting is December 13th. Right now, the market sees an 83% chance that they pause or don't hike, 17% chance that they would hike again. So we want them to, eventually cut, but pause. And then, people are thinking maybe early 2024, mid 2024, that's when we'll see the cuts. When they do start cutting, that's when we'll see, mortgage rates drop pretty quickly. The next thing we got September PCE, which is the Fed's favorite form of inflation. Both the headline and the core came in as expected, 3.4 and 3.7. Let's take a closer look at that. Month over month, headline was up 0.4, 0.3 for core. Remember, core takes out food and energy. The 2022 peaks was 7.1 for headline and 5.6 for core. So they come down quite a bit. But like Fed Chair Powell keeps pointing out, they want that core rate to get down to 2%. That's quite a long ways to go still. So we have some work to do there. We know that shelter inflation is working in our favor. So rent, the cost of rent basically is working in our favor. So as that moderates and comes down, then this core number should come down. And then for the headline, energy prices have been coming down. So hopefully that continues. Hopefully these inflation numbers keep coming down. I'm not sure if we can get to that 2% mark, but hopefully we do enough that they see the light, the error in their ways, and eventually they cut these rates. And then going back real quick, the other thing I wanted to show on this was, something that came up in this PCE number is our savings rate. How much money we're saving is down to 3.4%, from a high of 7.7% in February 2022. The depth of the Great Recession, that was down to 2.4. So we're heading the wrong direction. And we've talked about this before. If you look at this, the personal savings rates, it spiked in the pandemic when we got, our stimulus checks. And then since then, it's been basically coming down to the level it's at now, that 3.4. And then credit card usage, that was going up. That went way down when we got that money in our banks from the stimulus money. And since then, and since we ran out of that money right around here, that's been going up consistently. So savings going down, credit going up, that's not sustainable. Our GDP numbers were really hot. Our economy looks like it's going good. People are spending a lot of money, but it seems like we're spending it on credit. And eventually that will all catch up to us, especially with these high rates. So that's, like I said, that's not sustainable. So we'll have to keep a close eye on that and see where that goes. Next thing we got was the August Case-Shiller and FHFA appreciation numbers. This is important for our industry. So Case-Shiller and FHFA are always about a month behind. So Case-Shiller is at 0.9% for the month. Again, went to all-time high, 2.6 year over year, 6% pace for 2023. FHFA, which takes out jumbo and cash deals, that was about 0.6% for the month. And again, their 2023 pace is 7%. Zillow came out with a negative number for September, a slight negative number, but that's pretty seasonal and not a big number. So, this is a pretty good pace, between all these different metrics, about 6 to 8% for 2023. When you compare to that beginning of the year, a lot of people are talking about 5, 10, 15, 20, 25% home price losses across the country. So, just keep that in mind when we're looking forward to this year where there's not a lot of inventory. Home prices have stayed high. Even the doomsayers saying we were going to lose a lot of value across the board, and that just didn't happen. Next thing we got is jobs week. So first one, JOLTS, the jobs opening report, that came at 9.55, a little bit above expectations, but then they made a negative revision to the previous month. And again, this does a lot of double counting of jobs that are posted online, posted under different titles. So it's a little bit of a dicey number to pay really close attention to, but We know the Fed looks at it. Next thing we got ADP, private payrolls. That came in at 113,000 jobs created. So came down. It was about 150,000 was expected. And we can see it's been coming down. They're spread out by company size and in different industries. Annual pay increases moderated a little bit, which was good to see. The more money people are making, that leads to more inflation, at least according to the Fed. ADP, came in our favor yesterday. That definitely helped us. But tomorrow we get the big BLS jobs report. So this is one that's been hurting us in the past. It hurt us last month. It really hurt mortgage rates. So this one's supposed to come in about, depending on which one you look at, about 140 to 180,000 jobs created. Unemployment's supposed to stay at 3.8. So we got to pay really close attention to that. We're going to pay really close attention to part-time versus full-time, to that wage stuff. So that one comes out tomorrow morning. That's going to have a big effect on where we're going because we've been in a nice little rally the last couple of days. Initial job claims. Important unemployment claims expected at 210,000, came in at 217,000. So it inched up a little bit, but still really low. Continuing claims went up again. And what that just shows is that people, employers are trying to hold on their employees as long as possible. But when people do lose their jobs, they're having a harder time finding new jobs, with those continuing claims. So it's something, again, it shows the job market's strong, but it's pretty tight right now. So, something, again, that the Fed's paying close attention to. So we're going to have to pay really close attention to. Miscellaneous stuff. So the ECB and the BOE. So ECB, European Bank, Bank of England, they both paused. The European Bank had raised 10 straight times. So they're pausing. Global banks are pausing. And then the European economy is showing a lot of signs of slowdown, a lot of recessionary signs. United States economy seems to be hanging in there compared to the European economy. But all these global economies are connected often. So we're going to have to pay close attention to what goes on over there, what goes on in England and overseas, just because that's going to have an effect on our stuff, oil prices, things like that. And where does that leave us? So the average rate last week was at 7.9. We're down to 7.51. Like I said, the last couple of days with that ADP job report coming down and the Fed pausing and PCE, coming in kind of as expected, been a nice little rally. So we're down to 7.51. Still a long ways to go. Last year at this time I looked, basically a year to today, it was 7.2. Remember we kind of, spiked last November as well. So coming down, heading in the right direction, but it's really going to pay, a lot of it's going to have to deal with this BLS jobs report tomorrow. Speaking of, like I said, we got the BLS jobs report tomorrow. We got another one on December 8th. We got 2 CPI reports and another PCE report before that Fed meeting. That Fed meeting, the last one of the year on December 13th. Last chance they have to hike. We'd like to see that pause again. I don't think we'll see a cut, but you never know. So, like I said, everybody, we got to hang in there, definitely heading in the right direction. That's great to see. Home prices are hanging in there. That's good for current homeowners. And there's always, opportunities out there. So, if you have any questions about this or you need any help at all, please don't hesitate to reach out. I'd be more than happy to help. Have a great day, everybody.